Hello and welcome. You're watching Market Cafe with me, Ankita Saxena, and with me is Snehi Shah. This is the show where we get you all the roundup of how the global markets moved and what will move the Indian markets. But first up, what's happened on the global markets overnight, Snehi? We did see 11 days of consecutive gains coming in. Dow was up almost, 100 points?
Absolutely, Ankita. So good morning to you and good morning to all our viewers as well. Let me take you through what the global handover looked like, starting with the US markets then. And the Dow rose 0.5%, marking its 11th consecutive winning session. The Dow hit its highest level since April 2022 and had its highest close since February 2022 and also registered its longest winning streak since February 2017. Now the S&P 500 and the Nasdaq Composite also added 0.4% and 0.2% respectively, nominal gains coming for those two indices as well. Wall Street is also carefully awaiting the Federal Reserve's policy decision on Wednesday. All eyes will be on that. And the Fed Fund futures data shows a 98% probability of a quarter point hike according to the CME Fed Watch tool. Now, on the results front, you've got General Electric, General Motors and Verizon. They're all set to report their earnings Tuesday morning. Mega cap tech names such as Alphabet and Microsoft are scheduled to announce their quarterly results after the market close. Now, Wall Street will also be looking at July's consumer confidence data. So lots happening on Wall Street. Keep an eye out for all these cues. You've got the Fed meet as well as this important data queued. And shifting focus to Europe then, and European markets closed slightly higher on Monday as investors digested the inconclusive result of Spain's election and looked ahead to a busy week of corporate earnings as well as central bank meetings. Now, the Panced European Stock 600 provisionally ended the session up by 0.1%, very nominal gain, with the UK's FTSE 100 and DAX slightly higher as France CAC 40 dipped. Oil and gas stocks led sector gains, winning 1.5%, while media stocks fell 0.7%. So positive handover coming in from the US, flattish or mixed handover coming in from Europe. Important events lined up, the Fed watch as well as the consumer confidence data. But this is what the global handover looked like. Ankita, take us through what oil and crude also did.
Right, like you mentioned, the oil stocks rose yesterday in trade. Oil prices are surging, like I mentioned on Monday as well. Yesterday also we saw the uptick coming in the oil prices. They extended their gains from the previous session as signs of tight supplies and pledges by China authorities to shore up its economy lifted the sentiment. The crude benchmarks have already climbed for the 4 weeks in a row, with supplies expected to tighten due to the cuts from the OPEC+. Now, in China as well, which is the second biggest oil consumer, lenders have pledged to step up the policy support for the economy amid a tortuous post-COVID recovery, focusing on boosting domestic demand. And that's what is really aiding the oil prices. Tighter supplies and China saying that they will be boosting demand. So that is really aiding the crude prices, and we are seeing gains coming in. Brent crude is currently above the $80 mark. It is currently trading at $82.9 a barrel, and WTI is at $78.99 a barrel. So that's where the crude is at, Snehi.
Absolutely. So interesting set of data coming there, but let me take you through all the important cues that you should be keeping on your radar for the week globally as well as domestically. On the global front, you've got the US Conference Board on consumer confidence, so keep an eye out on that data like I mentioned. On India Inc. earnings front then, from the Nifty 50 pack, you've got a list of companies that will be declaring their results today. You've got Bajaj Auto, Asian Paints, SBI Life, Tata Motors as well as L&T. So big numbers coming in might make some moves on Dalal Street today then. On the global earnings front, you've got Microsoft, Alphabet and Visa that will be declaring their numbers today. On the corporate action front, let's come back to home then. For CET, you've got the board will be mulling proposal of fundraising today, and L&T board will also consider share buyback today. So lots of things happening on the street today. Keep an eye out for all these cues.
Alright, then we'll move on and we'll go on across to the news that made global headlines. Audio streaming giant Spotify is set to hike the subscription rates in specific countries except India. Meanwhile, the subscription in US will now cost $11 a month from $9.99. Meanwhile, iPhone manufacturer Apple is also considering of hiking prices of iPhone 15 and 15 Pro Max models as per Bloomberg report, in a bid to increase revenue during a projected slump in smartphone sales.
And Israeli lawmakers have gone ahead ahead and approved a key portion of the PM's divisive plan to reshape the country's judicial system despite massive protests. The vote came after a stormy session in which opposition lawmakers chanted shame and then stormed out of the chamber. Mass demonstration erupted outside the parliament building in Jerusalem and in central Tel Aviv after the vote.
And North Korea has fired 2 ballistic missiles just hours after when a US nuclear-powered submarine arrived in a naval base in South Korea. Both missiles landed in water off the Korean peninsula's eastern coast. South Korea has condemned the launch and said it gave a provocation that threats regional peace and stability.
And in a groundbreaking move then, Elon Musk and Twitter CEO Linda Yaccarino have revealed a new logo for the platform. The iconic bluebird symbol is now being replaced with a striking white X against a black backdrop. Musk's decision follows a poll among millions of followers, signaling a significant shift in Twitter's identity. Sumita Karir has all the details on this. Sumita?
Could you ever imagine seeing on Twitter anything but the iconic bluebird? Well, that has happened now as Elon Musk has rebranded the platform and he's introduced Twitter's new logo, which happens to be a white X on the back of a black background. Now, this, like I said, is part of a massive rebranding exercise that Elon Musk, the owner of Twitter, is undertaking in order to reverse advertiser exodus from the platform. He wants to also increase engagement on the platform of users. He also wants to sort of drive away some criticism that's been coming in from users as far as paid tweets are concerned or its subscription model is concerned. And secondly, and most importantly, he wants to make Twitter into an everything app. Now, this is not a surprise, but it's been in the offing for quite some time. We've often heard Elon Musk speak about an everything app or a super app akin to China's WeChat. So this super app, according to Elon Musk's plan, could have payments, it could have music, it could have audio, video, and so much more in terms of products and services. So he wants it to become a consolidated app for a whole host of services.
Well, the bird has finally been shot down. Let's see how the X pans out, really. But for now, we have Ray Wang, who's the principal analyst and founder of Constellation Research Inc., shares his take on the rationale behind this rebranding. Let's take a look at what he had to say.
But what Elon's pushing for is really the essence of free speech, the essence of being able to have a debate, the essence of not just picking sides and not having one-sided conversations. And that is going to win out in the end because people do like to have the debate and that conversation. Now, how he has done it might not have necessarily been the right way to do it. It's created a lot of controversy, but we've also seen that competitors such as Threads, which got to about 120 million active users, is declining because the network effects aren't big enough. The content isn't there. And that's where Elon has the advantage. They've actually refined the algorithms over time. They've done a good job trying to figure out what new algorithms are going to work. And so that's part one, getting the conversations back and going. Part two is actually making sure that the advertisers come back. And that is going to be the challenge. Right now with Linda Yaccarino there, that would help. But the challenge is really showing the advertisers why this platform is much more useful, how it's going to be more targeted and segmented, and why the users there are going to be much more profitable. But users who actually paid for the blue check mark and created content are super excited. They all got checks. And when they got checks for, some people got 5,000, some people got 20,000, some people got even more than that. And that's for creating content. And the ecosystem requires content creators, which is users, and it also requires advertisers, and it also requires subscribers. And he's going after 3 lines of revenue.
Hi there, welcome back and thanks for staying tuned to Market Cafe with me, Snehi Shah, and with me is Ankita Saxena. Now, shifting focus then to the occasion of Income Tax Day, Finance Minister Nirmala Sitharaman highlighted the importance of tax revenue and the new points to be added for the widening of tax. Listen in to that excerpt.
This change was also made only about 2 to 3 years ago, 22, I think, if I remember correct. We brought it in saying it can't be that somebody has to sit with his tax records for full 10 years. So that change was brought out, and even there, It cannot be done randomly by somebody. A principal chief commissioner will have to give the permission to reopen. These changes were consciously brought in for the benefit of tax assessees. Even now, there are observers of Indian economy who say that there can be a widening of the tax net. Even today, the widening is an issue about which we are talking. What will work? Nudge will work. Campaigns will work. That if it is above board and assessments are done, that is why the TCS and the TDS are always talked about. They are not newer additional taxes. Just track and trace. And therefore, there is a need for all of us to look at Indian economy and see how best we can contribute towards building a developed India by 2047.
Well, moving on then, working on instantaneous transaction settlement on stock exchanges, that's the word coming in from SEBI chairman Madhavi Buribuch. She said that the market regulator is working with stakeholders to improve the timelines. Here's an excerpt of what she said.
Just for equity and hybrid, the number is 24 lakh crores. So just half a day average benefit of earlier redemption means a benefit of 230 crores. So again, as you can see, very conservatively calculated and totaling up to 3,500 crores per annum is the benefit to the investors. So what this really does for us is to constantly motivate us to move into more and more structural encouragement to the ecosystem to deploy technology and therefore to be able to crunch timelines. And certainly one of the things that we think is not very far off is even instantaneous settlement on the stock exchange. We are currently working on that. We are engaged with the ecosystem and we believe that in the not very far future, we will have a mechanism which will facilitate instantaneous settlement of transactions on the stock exchanges. So that's where we are headed on that.
All right, that's the word coming in from the SEBI chairperson, but let's also get in Ankur Mishra to understand what this announcement means for the markets. Ankur, take it away.
Yes, quite a number of announcements coming from SEBI, and one of them has been the instant settlement of stock market transaction. Now, this will come after ASBA-like transactions happening for the secondary market as well, and the expectation is that this will also roll out very soon. Apart from that, there has also been important statement on Finfluencers part where the regulations are expected in the current fiscal year as well. Apart from that, there has been letters which has been written to the industry, and this is for the first time that SEBI is looking for industry body suggestions on the implementations wherein the rules which has already been drafted or even implemented, the industry body will advise how to implement it, what are the details on that. That will come out very soon. Apart from that, there is also an advisory committee which has been set under Keki Mistry, and this will be working on the delisting norms where there has been certain questions which were raised on the reverse book building process, and now this committee will look into it. Apart from that, there is also a committee which is on the trading plan of perpetual insider markets, making the market friendly. So now this committee will suggest on that. The whole idea which was repeated several times was the capital formation should happen as per the demand of the industry, and that is what the aim of the SEBI is. And there was also an example which was given on the technology-driven measures which SEBI has brought in, and due to that, investors have gained around rupees. There has been around 3,500 crore monetary benefit of the measures which has been taken by SEBI in the current in 1 year or so, which was calculated by SEBI on several assumptions, which was 4% saving rates as well as a 7% risk-free trade.
Well, moving on then, in an ET Now news break that has been now confirmed, last week ET Now had told you that the demerger of ITC Hotels business is on the cards, and the conglomerate's board has given its in-principle approval for the demerger. Now, the new entity will be called ITC Hotels. Now, we have learned from our sources that the company is looking for more investors. My colleague Vinny has all the details. Take it away, Vinny.
So absolutely what has come in terms of announcement, and we were the first to tell you all on 20th of July, and it was exclusive details, and the newsbreak has confirmed that ITC is going to be de-emerging its hotel business. That announcement has come in, and obviously now the board has given an in-principle approval for the de-merger of hotel business. That's going to be an incorporation of wholly owned unit for ITC that is going to be there for the hotel business, and ITC will hold 40% in this de-merged entity, and 60% will be held by the ITC shareholders. They've evaluated various alternative structures as well. They're going to be meeting on 14th of August to decide more in terms of the ratios, the details coming in over there in terms of the next board meeting. That is what they'll be watching out for, and obviously what they're proposing is to subscribe to shares of ITC hotels for an amount up to 100 crores in a total of aggregate. Now let's not forget, ITC currently accounts, the hotel business accounts only 5% of ITC's revenue over the last decade, and EBIT over the last decade was just 5%. SOTP valuation also is at around 4 to 5% as well when you look at it according to analysts and brokerages, what they have highlighted, and ITC Hotel stands second after IHCL in terms of the hotel business as well. So when you look at it in terms of SOTP valuation 4 to 5%, according to analysts, the value comes in at rupees 20 to 25, approximately 25 to 30 in terms of the pricing for the share price that it would be for the ITC hotel business. But now we have more exclusive details that have come in for you all, is that, you know, obviously that 40% up, what I'm talking about is that ITC will only hold 40% in this new entity. So obviously why is that so? Because in the later time ITC wants hotel business to be an independent entity, and ITC maybe could be scouting for strategic investors going forward, and they want hotel business to be something separately where it's like an investment they've made, and maybe they will look for a strategic investor at the right time, at the right price is when they will be looking at it. And that is more of the details, that exclusive details that we have for you all, and that we have picked up from sources, that obviously that what will be, that they'll be scouting for strategic investors at some point of time when they find the pricing right is what they'll be looking at, and ITC Hotel would be a separate entity. So those are more details that we have for you all in terms of the ITC Hotel demerger. And yes, the board will be meeting on August 14th, and we will be seeing some more announcements in terms of ratios coming in that time as well. All right, thanks Winnie for all those details on ITC Hotels demerger, but let's get a move on then, and there will be no rethinking on the 28% GST for the online gaming industry. ET now has learned from sources that the Finance Ministry is in no mood for further review of the tax. My colleague Prakash Priyadarshi has more details on this. Prakash, what are you picking up?
The Finance Ministry sources are informing that there is no rethinking on 28% GST on online gaming, the decision that was taken by the GST Council in its last meeting. We are given to understand that the Finance Ministry is not in favor of holding yet another round of consultation with the industry on this particular issue, as proper consultation has already been made by two GOM constituted by GST Council before arriving on this decision. Therefore, charging 28% GST on full face value is something which was decided by the GST Council unanimously. The only thing that the Finance Ministry may discuss at this point of time is about the implementation of this decision. We are learning from our sources that the Finance Ministry is open to discuss about the structure as to how this decision would be implemented going forward. When it comes to the issue that was raised by industry about the probability of growing illegal or fake platforms due to this decision, sources are informing that there is proper system in place to identify and track such illegal platforms. One important aspect that the sources are trying to emphasize is about the 28% GST. Sources are informing that 28% GST would only be applicable in a case where money is received, but it is still at 18% where money is not being received by player. So they don't see much impact on online gaming sector as being anticipated by industry. Sources are also informing that the government is planning to bring proposed amendment in current GST Act during current session of Parliament.
Well, then it's time for us to take a short breather there, but you don't go anywhere. After the break, we get you all the stock-specific news.
Hi there, welcome back, and thanks for staying tuned to Market Cafe. Let's shift focus to earnings then, and steel major Tata Steel reported a lackluster set of earnings for Q1. A 92% drop came in for profits, and what has led to this tepid performance? My colleague Ashesha is here to decode this earnings for you. Ashesha?
Well, yes, largely in-line set of numbers from Tata Steel this time. European operations continue to be a pain point. Europe EBITDA per ton has come in at a loss of negative $96 per ton versus negative $95 per ton that the company had reported in the previous quarter. Lower volumes, global macroeconomic concerns is why Europe continues to be a concern for the last several quarters. India operations meanwhile stood out. Volumes were on the lower side, but net realizations were on the higher side, and hence EBITDA per ton declined by a marginal 2.5% on a quarter-on-quarter basis. Meanwhile, company incurred a capex because of which net debt has risen from nearly 67,500 crores to about 71,500 crores, and that is a bit of a concern. In fact, we have a couple of brokerage notes that have come in. First up, let's talk about CLSA, which has maintained its outperform stance on the stock with a target price of 125. They say results were largely in line. Adjusted EBITDA was driven by income from long-term lease agreements with Tata BlueScope. Morgan Stanley, meanwhile, has maintained its equal weight stance on the stock with a target price of 110. They say standalone EBITDA was slightly ahead of estimates on account of better realizations that the company enjoyed in the quarter gone by. European operations could remain overhang in the near term. All in all, numbers were in line. Net debt has risen, which could be a concern. Brokerages are concerned about European operations and the fate of UK business, which depends upon the support that the company will receive from the UK government.
All right, moving on then. We'll move on then, and we have the quarter one poll. The Jubilant is set to report its quarter one results, and Vinny is joining us with what the street is really expecting. Over to you, Vinny.
So in terms of numbers that we are expecting from Jubilant Foodwork, revenue growth of around 5% is what we're expecting. Mainly, let's not forget there was a seasonality play that comes here because of IPL as well as summer holidays, which aids the revenues of the company. But other than that, when you look at the operating performance or the profitability of the company, that's seen a decline. We're expecting the profits to see a decline of 21%, margins to see a contraction of around 300 to 400 basis points as well. So yes, what is that main reason for contraction in margins is obviously that inflationary pressure has continued, whether you look at it in terms of the milk prices of the company, cheese prices, freight costs, that has all been on the higher end, and that is something that is impacting the margins of the company, and that is why a contraction in terms of margins. Like for like growth, that's expected to see a decline of around 2% as well. So negative 2% is what we're expecting like for like growth to be at, and that is mainly due to the customers down trading. Cheaper QSR options that are cropping up as well as aggressive competition are factors that one should watch out for as well. Other than that, in terms of factors that other than this we'll be watching out for is commentary that comes in from the management in terms of like-for-like growth, as well as what is their margin outlook going forward. How are they seeing these inflationary trends shaping up is a key factor to watch out for. Demand trends shaping up across geographies, across different cities is a factor to watch out for. Store expansion plans of the company in FY24, as well as the update on Popeyes are key factors to watch out for.
Alright, thanks Vinny for all those details. We will be keeping an eye out on Jubilant Foodworks quarter one numbers. But Spandana Spurti has released strong quarter one numbers, and my colleague Vamakshi is here with all the number crunching on those numbers. Vamakshi.
Well, yes, a strong set is what Spandana Spurti has reported this time around. Let's first look at how the AUM has panned out. AUM has come in at 8,848 crores, which is an uptick of almost 60.5% coming in on a year-on-year basis. It is also up nearly 4% on a sequential basis. Now, disbursements are also seeing a healthy uptick coming in at 1,664, an uptick of almost 26% is what they've reported on a year-on-year basis. But sequentially, yes, disbursements are down, and that is mainly on account of seasonality factors. But the positive is that the customer addition has been quite strong. Now we also saw that there was a sequential surge in yields because the company is continuing to enjoy pricing power given its unique customer base. NIMs came in at 14.2% versus 9.9%, so significant improvement as far as NIMs are concerned, both on a year-on-year basis as well as a sequential basis. Net interest income as a result came in nearly more than double, at coming in at 293 crores. PPOP, that is pre-provisioning operating profit, given the kind of cost rationalization that the company is doing, also came in much higher, and the company in fact reported a net profit of 119 crores, and PAT in fact has sustained over the 100 crore mark for the second consecutive quarter for as far as Spandana Spurti is concerned. Not just that, the asset quality was also quite robust. We saw an improvement as far as GNPA is concerned. It did see an improvement from 2.07% to 1.63%. NNPA also came in at 0.49%, and with this the credit cost has also moderated to a normalized level of nearly 1.5%. Now in the con call, the management also highlighted quite strong outlook. They expect to attain AUM of nearly 10,000 crores by the second quarter and 11,750 to nearly 12,000 crores by the end of this financial year. They have highlighted that the credit demand is very strong, and from the quality point of view, there has been a marked improvement. They're also progressing quite well as far as their Vision 2025 is concerned, and NIMs have further scope to expand due to residual repricing of portfolio and likely moderation in the cost of funds. So largely, all in all, it looks like a very strong set from Spandana Spurti, good commentary, and that is the reason why you should watch out for this counter.
All right, then. Thank you so much, Vamakshi. We will watch out for Spandana Spurti, but stay on there. You have all the brokerage notes that have come in this morning. Tell us, what are the brokerages saying? What are the stocks that will be in focus today?
Yes, let's first start off with TVS Motors. The company reported its Q1 numbers yesterday, and we have a note that has come in from Jefferies. They have highlighted that this is a new high of quarterly performance for TVS, so that is a positive commentary coming in for TVS. They've also highlighted that the two-wheeler segments in India has seen recovery, and the exports are also seeing to be bottoming out. There has been an improving margins, but their investments seem to be quite high. They believe that TVS could be a beneficiary of demand revival both in the domestic as well as the export markets. So largely on the back of that, Jefferies has maintained a buy rating with a target price of 1,550 rupees per share. The next stock on our radar is real estate major DLF. We have a couple of brokerage notes coming in after the company reported its Q1 numbers. Housing demand momentum continues is what CLSA has highlighted, and they believe that the company has a very strong new launch pipeline for the second half of the year. Demand for non-SEZ offices are quite strong, while SEZ, the offices out there still remain a concern. The DLF has re-entered the Mumbai market with a new project acquisition, and that is positive. So overall, it looks like a good set from DLF. CLSA has downgraded its rating, however, to outperform from buy, but nevertheless, they've hiked their target price to 547, while Jefferies has also maintained a buy. Target price has been hiked to 570 per share. And lastly, keep an eye out on auto stocks. We have a note coming in from HSBC. They have highlighted that the two-wheeler demand is likely to sustain. Unexpected recovery is expected in the entry segment. Still, they like the two-wheeler space and now prefer TVS as well as Hero MotoCorp. Bajaj Auto, they've downgraded their rating from buy to hold, but for Hero MotoCorp, they have an upgrade coming in. They've upgraded their rating from hold rather to buy, and also hiked the target price to 3,700 rupees per share. Eicher Motors, they're maintaining a hold, while for TVS, they're maintaining a buy. So largely, those were all the brokerages that you should keep on your radar today.
All right, Vamakshi, thanks for those details. We will be keeping these stocks on our radar on the back of these notes. But let's move on then. And auto majors Tata Motors and Bajaj Auto are all set to report their Q1 numbers today. Now, what is the street penciling in, and what are the factors that you should be looking out for? Ashesha is joining in with more details.
Well, yes, first up, let's talk about Tata Motors, where we are expecting a sequentially muted set of numbers this time. Consolidated revenues could come in at about 99,500 crores, which will be a sequential decline of about 6%. This is on account of volume decline that is expected to come in both from commercial vehicle segment as well as for JLR segment. As far as margins are concerned, we are expecting margins at 12.2% versus 12.1% margins that the company had reported in the previous quarter. JLR volumes are expected to be lower this time around, and JLR margins are expected to come in at 5.6% versus 6.5% that the company had reported in the previous quarter. Next up, let's talk about Bajaj Auto, where on a sequential basis we are expecting strong set of numbers on account of higher volumes that the company enjoyed in the quarter gone by. In fact, overall volumes rose by about 20%, and export volumes have also seen a sequential improvement of about 12%. Revenues expected to jump 18% on a quarter-on-quarter basis, and margins could come in at 19.2%, marginal decline from 19.3% that the company had reported in the previous quarter. In terms of management commentary to watch out for from Bajaj Auto, outlook on EV sales, outlook on export sales, and order book for Bajaj Triumph will be keenly awaited.
All right, thank you so much for that, Ashesha. But another stock that will be in focus today is Asian Paints, as that is also set to report its Q1 earnings. And as per the estimates, the company is set to report a rather healthy set of estimates. We have my colleague Lisa in the studio with us. Lisa, tell us, what is the market really penciling in for Asian Paints?
Well, good morning to you all. Asian Paint is expected to report revenue growth of around 9%. Volume growth is expected to come at around 10% on year-on-year basis. And the revenue growth is expected to be limited and restricted because there will be on the back of adverse sales mix, and this is because this stronger growth will be seen in waterproofing as well as the putty segment. Margin is expected to see some expansion, and this is on the back of contraction in the raw material prices. Now, the key commentary to watch out for will be the management commentary on the demand, especially the demand environment in the rural as well as semi-urban areas, which was hit last time. And also whether the pass-through of the raw material price moderation that will take place through price cuts and intensifying competition on the back of new players entering the paint segment, and also the capex plan and market share movement. So the Asian Paint is expected to report healthy set of numbers.
All right, Lisa, that was on Asian Paints, but we've also got L&T that is going to declare its numbers today. So what must one look out for? What are the factors to watch, and what is the street penciling in for L&T?
Right, Snehi. So L&T is expected to report revenue growth of around 14% on year-on-year basis, and this will be largely led by their core engineering as well as the construction segment. Margin is expected to witness some contraction, and that will be because of margin pressure seen in their infra segment. PAT revenue growth that will be driven by financial leverage. Order backlog that is expected to grow 11% on year-on-year basis, and it is expected to cross 4 lakh crore. Now, the factors to watch out for would be the progress on their non-core segment, that is the Hyderabad Metro as well as the other segments, and the new business segments also would be the factor to be watched out for. But all eyes would be on their buyback, their first ever buyback, and JM Financial, they are estimating that the buyback amount, it will amount to around 10,000 crore. And also on their FY24 guidance, the management had given a guidance revenue growth would be around 12 to 15%, while the order inflow that would grow at around 10 to 12%. So it is to be seen whether this guidance will remain intact. So yes, that's on L&T, which will report their earnings today.
All right, then all those stocks to keep a track of. Thank you so much for that, Lisa. Well, will we move on then and shift focus to earnings from life insurance majors? Now, SBI Life is all set to report its Q1 results as well. Let's go across to my colleague Harsh Saita to understand what we are expecting in terms of their results. Over to you, Harsh.
Right, so SBI Life expected to report a soft APE growth around 10% or thereabouts. That's annual premium equivalent. It's expected to come in around that 3,200 crore mark. It was at 2,900 crore same time last year. Of course, the quarterly number is not comparable. Q4 was a very strong quarter for all of the life insurance industry. Let's quickly move on to VNB. Value of new business expected to rise by around 8%. Again, extremely soft year on year. Expected to be around the 950 crore mark. You're also expecting margins for value of new business to be around that 30% mark. It will decline, of course, a slightly higher base of Q4 as well as of Q1 last year. You're expecting it around that 30% number. Now, in terms of the VNB margin itself, you are seeing that it was above the 30% mark in the last 3 out of the last 4 quarters. So this 30% odd mark is going to be the key to watch out for. In terms of the key other monitorables, one is going to be on the banca channel, how SBI Life is tapping into SBI, and whether that banca channel pickup is actually coming through or not. The other piece also is going to be with regard to commissions to SBI, whether there is a change on that. That could be a slight bit of negative also, but currently not a major risk or not a big expectation. Let's also look at non-par, how non-par will shape up in this quarter. Expected to be a tepid quarter for non-par, but you never know on the upside how it's playing out. Of course, growth commentary will also be in focus, as well as VNB, as well as VNB growth going forward will also be in focus. Margins as well, as to where directionally are margins going at the moment for SBI Life.
All right, thanks Harsh for all those details. Keep an eye on SBI Life and Trade today. But with that, it's a wrap on this edition of Market Cafe. But don't go anywhere. The market will take all the action ahead.